Good morning, dear students. So we are live, and this is the first time I'm doing it on the new channel. So I hope you're able to see the screen and you're able to hear my voice as well. If you just give a thumbs up, and hope all of you are well. How are you all doing? Good morning, Mohammed. Good morning, Inkeshwari. Great. Good morning, Saisha. We'll just wait for a minute or so that others can also join in, and then we'll start. Great. Good morning, Raja Lakshmi. Good morning, Rajanandini. Good morning, Kannammai. Great to see everyone coming up every day. That also keeps me also motivated, because I have to get up and go live early in the morning. It might be raining outside. It's still raining bad, but still it feels good to show up. And good morning, Akila. Good that each one of you are also showing up every day. That is what is needed, the consistency and the impact. You will see that by the end of the sessions, when we complete the entire course, you will have much more confidence and preparedness to face your examination. Good morning, Kanishka. So I think Kanishka Shukumar, good morning. Okay, so with whoever has joined, we will start off, and others can join subsequently. So yesterday we completed till how do we account in the case of manufacturer and dealer lessor. Very important for you to practice the question for manufacturer, dealer, lessor, because that is where complexity can arise in terms of valuation. Okay, how to account for it, how much to account for it, and all of that. So that becomes challenging. So it's important that you practice the question once again on how to recognize revenue, why the residual asset is recognized, how do we determine the cost of goods sold, and also the journal entry. The journal entry sounds simple, but can be tricky at times, right? So that is what we had done till yesterday. Good morning, Murli. Now, moving on to the last leg of what we will be discussing, lease modification. So earlier we discussed about lease modification in the books of Lessee. Now we'll be discussing lease modification in the books of Lessor. Now, lease modification in the books of Lessor can be of two types. When I say two types or two categories, we can classify. If the lease modification is for a finance lease, see, in Lessee there was no operating, no finance lease. In Lessor, we have an operating lease and a finance lease. Now, if the lease modification is a finance lease modification, then you will see whether it meets the separate lease criteria. Now, when does it meet the separate lease criteria? When there is an increase in scope and the increase in price is commensurate with increase in scope. The same lessee conditions, if that is satisfied, then you will say, I will account for it as a separate lease. Then you will do initial recognition, subsequent measurement as if it is a separate lease. So same logic what you have done in case of lessee, same thing would apply here. But if it does not meet a separate lease criteria, then what do we need to check? We need to check that whether this finance lease would have been classified as an operating lease based on the modified terms. Okay, so because of the modification, for whatever reason, for example, there is a modification, we have reduced the term. Now when there is a modification and we have reduced the term, and because of which now it will be classified as an operating lease, means if I am looking back at the terms again, it would now be an operating lease if I am applying these terms since inception. Then in that case what you will say is existing lease is terminated. So we are evaluating a finance lease. That finance lease is modified. That modification means that it would have been classified as an operating lease. Now because it would have been classified as an operating lease, what we do is we will consider that the existing lease is terminated and the asset whatever was there as the closing balance of net investment in lease, that becomes my asset in the new for the new accounting. So to summarize once again, earlier it was a finance lease. Now when there is a finance lease, we have net investment in lease, right? This is something which is receivable and we do not have any asset. Now what are we saying? This finance lease when I am reassessing, it cannot be, or when it is being modified, it cannot be accounted for as a separate lease. But because of the modification, this would have been an operating lease since beginning. This would have been an operating lease since beginning. If that is the case, what the standard says is terminate the finance lease and recognize. Now when I am saying terminate the finance lease, this net investment in lease is no longer existing because I am terminating the finance lease. So this net investment in lease, whatever is there, that becomes the asset value. For example, let us say PPE. Okay, so whatever is the closing balance here, this closing balance, you will take it as PPE amount and you will close the net investment in lease. And considering this, you will account the operating lease subsequently as a new lease. That is which case? That is the case where you have existing finance lease. It does not meet a separate lease criteria, but it would have been classified as an operating lease since inception. If the condition is met, you terminate the existing lease and you recognize an underlying asset, a new underlying asset, which is equal to net investment in lease. Now, there is a lease modification. It cannot be recognized as a separate lease. It cannot be recognized as an operating lease. It continues to remain your finance lease only. But there is a modification. Then you will apply Ind AS 109. And when we say apply Ind AS 109, what we mean is the lease receivable value should be remeasured applying the principles of Ind AS 109. Right? When we understand Ind AS 109, you will understand how these things are done, changes and all, how lease receivable or how a financial asset is measured and all of that. That will cover when we do Ind AS 109. Okay, so let's have a look at this example. Lessor L enters into an 8-year lease of 40 lorries with lessee M that commences on 1st of January. The lease term approximates the lorry's economic life and no other feature indicate that the lease transfer or does not transfer substantially all of the risk and rewards incidental to ownership. Now what is the meaning of this? The lease term approximates the lorry's economic life, meaning to say whatever is the lease term, that is equal to or almost equal to the economic life. Now when that is the case, what do? We classify it as a finance lease. We classify it as a finance lease in the books of lessor, right? Then assume L classifies this as a finance lease. During COVID-19 pandemic, M business was contracted and in June 2020, L&M amended the contract so that now it terminates on 31st December of 2020. COVID-related amendments and all, those are no longer relevant, so much in depth, so I will not be covering them. But here there is a normal termination on 31st of December. Early termination was not a part of the original terms. So whatever was the termination, whenever they're terminating the lease, it was not part of the original terms and is therefore a lease modification. The modification does not grant an additional right to use underlying asset, therefore cannot be accounted for as a separate lease. How should this be accounted? Okay, so earlier it was a finance lease. Okay. Now this finance lease was based on what term of the lease. Now we are reducing the term and now it is a lease modification, and this modification would result in a lease being modified to operating lease, right? So earlier we took it for how many years? They said approximate 1st of January year 18, and now it is being terminated as on June 20. They have decided to terminate on 31st of December. Now these kind of cases, what happens is, because of this modification, this becomes an operating lease. Now when this becomes an operating lease, whatever is lease receivable, that is there in the books, this will be credited, and you will debit the lorries or asset, which will be debited. By what amount? Whatever is the closing balance in the net investment in the lease. Okay, so that is what they will do. Subsequently, this asset will be depreciated, and the balance income, whatever is there, that will be recognized on SLM basis. Now here, because it's only a 9 months period, June 20 to December 20, 6 months period, that is how you will account for it. Okay, that is the part related to modification of lease in the books of lessor. If it can be recognized as a separate lease, recognize. If it cannot be recognized as a separate lease, then you have to check whether it becomes an operating lease or not. If it becomes an operating lease, de-recognize the finance lease and create an operating lease. If it cannot be recognized as an operating lease separately, then you will apply the principles of remeasurement of financial asset as per Ind AS 109. Now moving on to the disclosure requirements. Or this one more thing. If it is an operating lease modification, then you will account for it always as a new lease. Then if there are any prepaid or accrual of lease payment, now here some students do have a doubt, sir, what is the meaning of this accrual of prepayment? What happens is, if we come back to what we discussed yesterday, first year income is 1 lakh. First year income is 1 lakh. If those of you had attended yesterday, this first year income is first year payment is 1 lakh. Income is 1,50,000. Means what? 50,000 is due. 50,000 is due. This is called accrual. This is called accrual. Means the lessor has to receive 50,000. So that whatever amount the lessor has to receive, that he will include as a part of lease receivable when he does the accounting for it. So any prepayment or accrual, you will adjust it towards the new lease activity. So for example, this 50,000 whenever it becomes due, that automatically gets captured into your calculation of lease receivable. That is what is the meaning of thing. Sometimes it may be excess payment, maybe there is a prepayment. Prepayment will be treated as if you have already received that payment, and accordingly adjust the lease accounting or lease receivable. Then moving on to the presentation aspects in the books of lessor. Presentation and disclosure. In case of finance lease, they will show a receivable which is net investment in lease, which will be classified as current and non-current asset. For operating leases, if it is a tangible item, you will follow Ind AS 16. If it's an intangible item, you will follow Ind AS 38. That is what will be done. Disclosures, you can have a look at it once on your own. So whatever are the disclosures related to finance lease and operating lease. This is what will be discussed. Now we'll move on to some specific aspect where we need to be careful about accounting, or how do we account for the transaction. The first one of these is subleases. Now, meaning of sublease is, let us say I am the owner. I have leased an asset to a tenant. So this is called head lease, means the first lease. The tenant has the right to sublet to another person. Let us say there is a company, Reliance, my favorite examples in the class. Okay, so I am the owner of a property. I have given it to a tenant. The tenant has given it on a sublease to Reliance. So now I am the lessor. This tenant is a lessee for the head lease, and it is the lessor for the sublease, and Reliance is the lessee for the sublease. These kind of arrangements are called subleases transaction. So sublease is a transaction where an underlying asset is released or released, means leased again by a lessee. This particular lessee, this tenant is also called an intermediate lessee, to a third party, and the original lease between the lessor and lessee remains intact. So that is how what is the meaning of subleases. Now here, as far as I am concerned, I am an owner. I have given it on the lease. I will see whether it is a finance lease or an operating lease, and accordingly I will account for it. This particular tenant has to do two accounting. This tenant has to do two accounting, one as a lessee and one more accounting as a lessor. So as a lessee, again I have a right of use asset and there is a lease liability. This is what the accounting will be, whatever we have understood. Now when it again becomes a lessor, then what is to be done? When it again becomes a lessor, then the lessor will calculate implicit rate of return or interest rate implicit in the use in the lease. For what? For the fresh sublease. Sir, if you cannot calculate this, then use the interest rate of the original lease. Okay. So two things. One, the lessor will calculate interest rate implicit in the lease. Most likely it can be determined. If this cannot be determined, then you will go back and you will say that whatever is there in the head lease, that is the amount or that is the value at which we will consider the accounting for it. Now, when the lease accounting happens by the lessee, what we need to check is, if there is a head lease, then the sublease is a finance lease. Sublease is a finance lease. Now, when I'm saying sublease is a finance lease, please visualize this. The lessor got or the lessee got a right of use asset. When the lessee got the right of use asset, the lessee gave that right of use asset to somebody else. Now, in that case, if the sublease is a finance lease, then what it means? Basically, it means that the risk and rewards of the right of use assets are also transferred. So, if the lessee has right of use asset and this is being given out on a finance lease, then what does it mean? It means that this right of use asset, the risk and rewards, the RR, has been transferred. The risk and rewards has been transferred, which means it becomes a finance lease. And in finance lease, what do? In finance lease, we have understood that you will recognize a net investment in lease. The first thing. Second, when you have to recognize a net investment in lease, you have to de-recognize an asset. Now, how do I de-recognize the asset? I will de-recognize the asset by de-recognizing the right of use asset. I will de-recognize the asset by de-recognizing the right of use asset. Okay, so I will debit net investment in lease. I will credit right of use asset in this particular scenario. So what about the original lease liability? See, the original lease liability continues. You do not do anything for the original lease liability. Okay, if that is the case, then if the sublease is an operating lease, then there is no challenge at all. You will account for it as a new lease, which is an operating lease, and original lease continues as it is. Now, in the case of a finance lease, please remember we are de-recognizing the original right of use asset. Okay, so just once again a quick summary. If the sublease is a finance lease, de-recognize right of use asset, recognize net investment in lease, your original lease liability continues. Sir, how will the sublessee account for it? The sublessee will account for it as any ordinary lessee. Only challenge comes is in the case of an intermediate lessor. Okay, then intermediate lessee. Then if it is an operating lease, you will account for it as a separate operating lease and you will continue. Okay. Now, if the head lease is a short-term lease, then the sublease will also be an operating lease, because if it's a short-term lease, you would have taken some exemptions which you will understand subsequently. You will separately account for it as an operating lease. Okay, so that is one thing. So if you have taken the exemption of short-term lease, which we will be understanding subsequently, in that case you will consider it to be an operating lease and there is no impact on the existing transactions. Okay. Now, another important parameter or another important aspect that we need to understand is that of sale and leaseback transaction. Now, why do we enter into a sale and leaseback transaction? For example, I am the owner of the property. I want money. When I want money, I have sold the asset to the buyer. I want money. I needed money. So one option was to take loan. I didn't want to take loan. I sold the asset to a buyer. But I want to use the asset. Please think of this carefully. I have sold the asset, but I want to use the asset. So what I told the buyer that you please give this back on lease. Please give this back on lease to me. So what happened? This owner became a lessee. This buyer became the lessor. So there is a owner who is the lessee. We call it seller lessee. And the buyer became the lessor. And there is a lease. So if these kind of transaction exist when on one leg there is a sale transaction and on the other leg there is a leaseback transaction, that we say that it is a sale and lease back. Sale and lease back transaction. So what is the meaning or what is the impact of this? Think of it. This is the owner who has sold the asset. So visualize, understand this logic very, very carefully. This is the balance sheet of the seller. The balance sheet had an asset. Now this balance sheet had an asset. Now there is a buyer. This asset has moved from the seller to the buyer. This asset now no longer here, it goes back here. Then there is a lease back. When there is a lease back, what does the lessee do? The lessee recognizes ROU asset. So here it will become a lease receivable. For example, assuming it's a finance lease, it is coming back as a right of use asset. So think of a scenario where asset is still with me. I have the property. I am using the property. I am controlling the property. I have just sold it and I have taken it back on lease. Now the asset has not moved, the use has not moved and all of that. But by doing all of this drama in the balance sheet, I can actually recognize some gain or I can recognize some loss as per my suitability. Okay. So sale and leaseback accounting becomes very, very important because we need to actually look at whether there is an actual sale or we are just saying it is a sale. For example, if this asset is given on sold to the buyer and the lease back is a finance lease. Finance lease means what? By selling, I am transferring risk and rewards. By taking back on finance lease, I am again taking back risk and rewards. So what we need to understand is that what is the underlying transaction? We have to open up the transaction and we have to see how do we account for these kind of structured transaction. Please remember, sale and leaseback has to be a part of a single contract or a combinedly negotiated contract, and that is where we will have the sale and leaseback related accounting. Now, how do we account for sale and leaseback? For accounting for sale and leaseback, we have to check Ind AS 115. These two standards are the most important standards as far as the revenue and asset accounting is concerned. Look at Ind AS 115. As per Ind AS 115 is control past. Because under Ind AS 115 also, when we understand revenue recognition, we will say to recognize revenue, we are saying sale. To recognize revenue on account of sale, the control must be past. Is control past? If the answer is yes, you will recognize a sale. You will recognize sale. Okay. If the control is past. If the control is not past, no sale can be recognized. You cannot recognize a sale. So then how do we account for it? That is what we will be understanding. First you need to check, as per Ind AS 115, in a sale and leaseback transaction, is there a sale? Is the control passed? If the answer is yes, then you will account for it as a sale transaction. If the answer is no, the sale is not completed, the control is not passed, then in that case what you will do, the sale cannot be recognized. So if the sale cannot be recognized, what we will do? If the sale cannot be recognized, this owner, seller, will continue to recognize the asset. There is no derecognition because there is no sale that is happening, right? So that is what we need to understand when it comes to sale and leaseback transaction. Now, so this chart again summarizes. Let me just share this with you. Sale and leaseback criteria. If 115 criteria is met, that is control is passed, you will recognize as a sale and purchase. Means you will say that there is actually a sale, and separately you will account for lease. Now this accounting for lease we will understand using an illustration because theoretically it will be difficult to understand. Okay. Now when you account for lease, you will recognize ROU asset. That is one thing, because we are saying I'll account for it as a lease. Gain or loss on portion transfer, this will understand what is the meaning of portion transfer, and the lessor applies the lease accounting model. So lessor will apply whatever the lease accounting tells. If the control is not passed, seller continues to recognize the underlying asset, buyer will not recognize that asset, and it will be considered to be a financing transaction as per Ind AS 109. Now, what is the meaning of financing transaction? It is basically will be considered as a loan taken by the seller, right? So if control not passed, okay, we have a seller, we have a buyer. Actually, they are saying we have sold, but control is not passed. The seller still controls the asset. The seller still controls the asset. Sorry. The seller still controls the asset. Now, when control is not passed, what happens? Buyer has paid some consideration, and seller will make lease payments. But we are saying, sir, the control is not passed. The control is still with the seller. If the control is still with the seller, this consideration is nothing but a loan taken, and the lease payment, what we call, that will be like the repayment of the loan. You will account for it as a financial liability and financial asset as per Ind AS 109. Okay, that is the aspect when the control is not passed. But if the control is passed, what do we do? If the control is passed, we will account for right of use asset in the books of the buyer or the seller, and the asset will also be de-recognized, and the lessor will apply lease accounting model. Now, sometimes what happens is the sale proceeds are or may not be equal to fair value. So I have a question for you here. Please answer them so that I get to know that you are following whatever is being taught. I have a property which is worth 50 lakhs fair value, sold to the buyer fair value, transaction price 80 lakhs. First thing, will the buyer buy a property which has a fair value of 50 lakhs at 80 lakhs? Will that thing happen? Will the buyer pay 80 lakhs for a property which is worth 50 lakhs? Okay. Now, if there is a transaction where the buyer is selling it or buyer is buying it for 80 lakhs, then how will he compensate? He has bought at a higher amount and there is a lease back. How will he compensate? How will he compensate? If the buyer has purchased at 80 lakhs, how will he compensate the transaction? Will he charge higher lease rentals or will he charge lower lease rentals? Will the buyer has paid higher amount to buy the asset, then will he charge a higher lease rental or lower lease rental? So this is where I had a think of it, you are the buyer. Okay, whenever you get confused in these kind of scenarios, think of it, you are a buyer. You paid 80 lakhs for something which is worth 50 lakhs only. So to recover that amount, because you have paid higher amount to the owner or the seller, when you give it back on lease, you will say, Mr. Seller, I paid 80 lakhs instead of 50 lakhs. Now you have to compensate me by paying a higher rental. So the rent will be higher. If I sell it at a lower rate, then the rent will be lower. Okay. So whenever these kind of transactions happen, there is a mismatch in the fair value or the transaction price. Then in that case, what we do is we have to adjust that if the transaction is not happening at fair value. So if the sale proceeds or if the transaction price is not at fair value, the sale proceeds are adjusted if the transaction does not happen at fair value. That is in two scenarios. One scenario, the selling price is not the fair value. Second scenario, the lease rentals are not market lease rentals. The first scenario, sale proceeds are not equal to the fair value. Second scenario, payment for lease are not at market rates. So what you do is, if you identify a scenario where the asset is not sold at fair value or the lease rentals are not at fair value, in that scenario what do you do is, first you will see what is more determinable. What is more determinable? Okay, either the sale proceeds and fair value or present value of lease payment and present value of market lease payment. Which of the two is more determinable? You will check that. For example, more determinable means which can be readily identified, which can be readily determined. If this is more determinable or this is more determinable, you will check. If once you have identified that okay, sale proceeds and fair value are more determinable, meaning to say sale proceeds is equal to 80 lakhs, fair value is equal to 50 lakhs. Okay, now here what happened? Sale proceeds are greater. Okay, 80 lakhs, actually it should have been 50 lakhs. So what do? Is we say that the sale proceeds will be 50 lakhs. So you will credit to the revenue or credit to the sale account or credit to the disposal of asset at 50 lakhs. Sir, what about additional 30 lakhs? Buyer has given me additional 30 lakhs. So that additional 30 lakhs will be considered as additional financing of 30 lakhs. This is one area where a lot of students get confused, that is, how do we do the accounting for? First you have to determine which is more, sale price or fair value, or lease rental or market lease rental. Okay, so if sale proceeds or present value of lease payments, whichever, if that is greater, then it means that the additional amount that has been received is your financing component. So if it is lesser, for example, fair value is 50 lakhs, sold at 40 lakhs. If fair value is 50 lakhs, sold at 40 lakhs, then what do? If the fair value is 50 lakhs and it is sold at 40 lakhs, it means that I have sold for a lesser amount. Why will I sell for a lesser amount? Because I will receive a concession in the lease receivable. So instead of selling at 50, I am selling at 40. That will be considered as if I have done a prepayment for lease. So why prepayment? I would have sold at 50, but I sold at 40. Means I gave 10 lakhs worth of asset for free. That asset which is being given as free is considered to be prepayment for the lease. Okay, that is how it is accounted for. Now, a very important question, sale and leaseback transaction. Let me share this with you. Sale and leaseback transaction. Please read the question carefully, and this one question will help us understand the concept comprehensively. An entity, seller lessee, sells a building to another entity, buyer lessor, for cash. So seller lessee, buyer lessor, for cash of 30 lakhs. Immediately before the transaction, the building is carried at a cost of 15 lakhs. At the same time, the seller lessee enters into a contract with the buyer lessor for the right of use building for 20 years with annual payments of 2 lakhs per year. So sold for 30 lakhs, lease back for 20 years at 2 lakhs per annum. The terms and conditions of the transaction are such that the transfer of the building by the seller lessee satisfies the requirement of determining when a performance obligation is satisfied as per Ind AS 115. This, those of you who have not seen Ind AS 115, no need to worry. What it simply says is the sale criteria is met. The sale criteria is met. The fair value of the building on the date of sale is 27 lakhs. How much did we sell for? 30 lakhs. Means we collected 3 lakhs extra. That's the first thing you have to keep in mind. Then initial direct costs are ignored. Okay. Interest rate implicit in the lease is 12% per annum. The buyer lessor classifies the lease of the building as an operating lease for the buyer side. How should the transaction be accounted for by the seller lessee and the buyer lessor? So let me just copy this question. Okay, this is the question. Now here, multiple things that we have to keep in mind or understand is, sale price is 30 lakhs, fair value on the date of sale is 27 lakhs. What is that additional 3 lakhs called? I should have sold at 27 lakhs, but some the party has purchased it at 30 lakhs. Now that additional 3 lakhs will be called what? Anyone? If both are readily determinable, we'll give preference to the selling price because that is more evident than the market lease rental. So one question on sublease. Okay, that we'll see if today if time permits, or I will see if I can pull out a question and I can share it with you separately. Okay, I missed that thing there. So there is an additional financing. So first thing is, please pay attention now on this sale and leaseback transaction. First thing is, the additional amount that is received means I should have received only 27 lakhs. I should have received only 27 lakhs. Okay. Some adjustments. I should have received 27 lakhs, sold at how much? 30 lakhs. Means what? I got 3 lakhs extra. Whenever you receive extra money, so one way to remember is, whenever you receive extra money, that is an additional financing. Or whenever the seller is paying extra lease payment, that is also part of financing. So 3 lakhs will be considered as additional financing. That's the first thing. Okay, additional financing means loan taken by the seller lessee and loan given by the buyer lessor. That is the first part of it. Now, seller lessee enters into a contract with the buyer lessor for the right of use of the building for 20 years with annual payments of 2 lakhs at the end of each year, and the interest rate implicit in the lease is given to be 12%. Now, from the lessee's point of view, please remember, lessor is saying, operating lease, but the lessee has to account for it as what? Lessee has to account for it as right of use asset and a lease liability. Lease liability is what? Lease liability is present value of, now see, it is a simple present value calculation. So I expect that all of you know how to calculate present value, or independent if you want to calculate after the class, you can do it. Okay, present value at 12% for 20 years and payment of 2 lakhs. That becomes 14 lakhs 93,888, or we can round it off to 14 lakhs 94,000. Okay, so 14 lakh 94,000 is the present value of lease payment. Okay, we have done, or you would have done enough number of questions on calculation of present value, so I will not be spending excess time there. Rather, I will try to cover more concepts in that time frame. Okay, present value of lease payment is 14 lakh 94,000. Now, what does this mean? 14 lakh 94,000, whatever it means, is your present value of lease payment that will be making the payment to the lessee, 14 lakh 94,000. Now, please understand, this 14 lakh 94,000 that we are paying in present value terms has two components. What are those two components? First component is additional financing. Second component is lease. You need to say, when the fair value of asset is 27 lakhs and loan is 3 lakhs, this 14 lakh 94,000, whatever is the present value of the lease payment, out of that there is one component which is pertaining to the fair value of the asset being transferred. Second component is pertaining to your loan amount. But one more thing what you have to understand is fair value of asset being transferred. This fair value is for full life. But are we taking it for the full life? No, we are not taking it for the full life. How much are we taking it for? This 1494 is what represents the amount that is pertaining to what we will pay to the lessor. Okay, 1494 is what we will be paying to the lessor. Now, out of this 1494, whatever we have, right? How much should be pertaining to, or what is the amount should be pertaining to the lease payment, and what is the amount to be should be allocated to loan payment? Now we are paying how much? Annual payment is 2 lakhs. Every year we are paying an amount of 2 lakhs for the lease transaction. We have entered into a lease transaction. We are making a payment of 2 lakhs for that particular lease transaction, right? Now, when I am making a payment of 2 lakhs for the lease transaction, I am also repaying the loan amount. I am also repaying the lease portion. I am repaying the loan amount, that is the first part. I am also repaying the lease related portion. Now, out of this amount, whatever I have to pay 2 lakhs, then how much of that is related to lease accounting? So, or lessee, the lease portion, and how much is amount for loan component. Okay, now the present value of lease payment, the total lease payment, see, total lease payment is 1494, and out of that I am saying 3 lakhs pertains to the loan provided. So for loan it would be 2 lakhs is the total payment. This represents 1494. Out of that, my loan is 3 lakhs. So 40,160. My 40,160 is something which is pertaining to the loan taken. And the balance amount, 2 lakhs minus 40,160 is pertaining to the lease taken. Okay. So we are splitting that between the amount of lease and the amount of loan. Now this bifurcation is important because loan will be accounted as per Ind AS 109 and lease will be accounted as per Ind AS 116. Is there any confusion here? Okay, great. Now, one more angle here we need to understand is present value of payments is 1494. This I told includes lease plus loan. Okay. Now, present value of payment includes lease plus loan. Present value of loan is 3 lakhs. So, present value of lease payment will be 1494 minus 3 lakhs 1194. Because today I am getting 3 lakh worth of loan and 2 lakhs that I am paying includes both the loan amount as well as the amount pertaining to your, what do you call, lease payment. Now, I have an asset worth 27 lakhs and having a carrying amount of, as per the question, 15 lakhs. Now, this is where again you have to pay slightly extra attention. So, fair value is 27 lakhs, carrying amount is 15 lakhs. I have transferred this asset, and again, I have retained some right on that particular asset. I have transferred that asset and I have retained some right on that particular asset. Think of it. I have transferred that asset. I have transferred control, but I also got back the right to use a specific period of time that particular asset. Okay. Now, what is the value that I am attributing to my right to use the asset? So, my value is 11,94,000. That is what we have calculated. The present value of lease payment represents that I have 11,94,000 of right which I can use on that particular asset. Out of 27 lakhs, I can use 11,94,000. So, what is the carrying amount? Carrying amount is 15 lakhs, which means when I have to de-recognize the asset, I will not de-recognize fully 15 lakhs. What I will say is, I have an asset worth 15 lakhs. I have transferred 27 lakhs and I have got back right to use 11,94,000. So 15 lakhs divided by 27 lakhs, 15 lakhs divided by 27 lakhs multiplied by 11,94,000. This represents the portion transferred. This represents the portion transferred. Portion transferred is whatever, sorry, portion retained, not transferred, my bad. This represents the portion retained, means out of 15 lakhs of carrying amount, 6,33,333 is retained. 6,63,333 is retained portion because that I have a right, and transferred portion is 15 lakhs minus 6,63,000, 8,36,000 is the transferred portion. Okay, 6,663 is the retained portion and the balance part is transferred portion. Okay, now here 27 lakhs minus 11,94,000. See, fair value that I gave and the right that I am retaining, that difference is 15 lakhs 6,000. So that is the fair value, or that is the net amount we can say that it is transferred. Okay. Now, gain 15 lakhs minus 836, the gain that I have to recognize, which is transferred, that is rights transferred, is 669. This is one way to understand this. Another way to understand this is total gain is 27 lakhs minus 15 lakhs. Sir, why are we not comparing 30 with 15? Please remember 3 lakhs is additional financing. Total gain is 12 lakhs. Out of this 12 lakhs, whatever I have made the total gain, the fair value is 27 lakhs. Out of the total gain of 12 lakhs, the fair value is 27 lakhs, and out of that 27 lakhs, I have retained 11,94,000. So this is the gain which is retained, which cannot be recognized because I am giving the asset, I am taking back that asset. So for the portion that I have retained, I cannot recognize gain. So balance 12 lakhs minus 536.67, 6,69,333 is the gain that can be recognized by the lessee, or that can be recognized by the seller lessee. Okay, so now coming back to the presentation. So we have calculated additional financing. Then whatever you are paying, that reflects two part. 1494 is the total payment. Out of that, 3 lakhs is my present value of the loan. 3 lakhs is my present value of the loan. So 40,160, what we have calculated, pertains to additional financing, and balance pertains to lease. See, another way to cross check is it briefly is, I'll just give you one more way. If I have taken a loan of 3 lakhs, period 20 years, rate 12%. My EMI will be 12% for 20 years, having a fair value of 3 lakhs, today's value of 3 lakhs. So that amount comes to 40,163. So this is another way to calculate, but not advisable for the exam purpose. 40,163, what we calculated here, 160 or 163, that difference, that is nothing but my EMI for the loan. So whatever the seller has received from the buyer, 3 lakhs is loan, for which EMI is 40,160, and balance component is the lease payment. Okay, that is how you need to understand. The underlying logic which goes behind that is this particular one. So this we have done. We have calculated the gain. Now how do we account for the gain? 669 we have calculated the gain. Whatever amount is received, 30 lakhs, debit cash or bank. Then whatever asset we need to recognize right of use asset, 6,63,000, that is the present value attributable to the asset portion that we are retaining. Okay, that is 6,63,333. We will de-recognize building, which is the carrying amount of 15 lakhs. We will recognize the finance liability of 14 lakhs 94,000, and then the gain on rights transferred 669,333. Now here, please understand, one place where a lot of students will have a doubt is, sir, here we said lease payment is 11,94,000. That is, the right of use asset is 11,94,000. Why are we recognizing only 663,333? This is because this is related to cost. What are we doing? 15 lakhs is the carrying amount. Out of that, I am retaining 6,63,663. Sir, why not show it at a higher value? Then it would be like, I am selling the asset and then I am immediately recognizing gain. That should not be happening. Okay, that is how we will recognize. For the buyer lessor, it is very simple. Building is purchased at 27 lakh, loan of 3 lakhs, and credit the cash. Okay, so that is how we handle this situation. Go back and revisit this question once again. Very, very important, because especially the splitting part between the right retained and the right transferred, that is very, very important. Okay, then moving on. Disclosures, you can look at the thing now. Transition approach, again a critical part generally now, because see, when it was initially launched, the standard, then it was very, very important. Nonetheless, it is important to know what is this transition approach, because we never know, you may be having a transition from AS 19 to Ind AS 116 and the question may come in the examination. So that is one more thing. Now, what is this transition? Transition basically is, earlier we were under Ind AS 16, not Ind AS 16, Ind AS 17 or AS 19, and now we have transitioned to Ind AS 116. So how do we transition? Now there are some exemptions and there are some relaxations given. So what the lessee can do is, the lessee can choose to review all its existing contract and see whether the existing contracts also contain a lease as per the new definition. That is one option. Now that may be a lot of time consuming. So what the lessee can do is, no, I will forget whatever is done is done. I will only apply the lease definition to new contracts. So if in the past there was not a lease contract, I will not take extra burden, go back and say, oh, that contains a lease, and I'll do all the working all over again. So that will not be done. Okay, that will not be done. Now, the second thing will not be done means it depends on the entity. Second thing is, I will say only new from today onwards, whatever is a lease contract, that only I will apply the definition of lease and check whether it is lease or not. That is the first thing. Then, how do we transition? Very, very important. First, transition option for the lessee. You can say take full retrospective approach. You will take full retrospective approach means you will go back and apply Ind AS 116 as if it was always applicable. As if it was always applicable, and you will restate the comparatives. That's the first approach. The second approach is modified retrospective approach. What is the meaning of modified retrospective approach? In case of modified retrospective approach, you will not go back and restate comparatives as if Ind AS 116 was always applied. What you will do is difference between the asset and the liability recognized, you will adjust in the retained earnings. So first one, you will do a full retrospective approach, go back, restate it fully. Second approach is modified retrospective approach, where you will not go back and do a original date application. Means, for example, if I have taken a lease 5 years back and today it is a transition, in full retrospective approach I will go back right from the beginning and I will say, okay, this was right of use asset, this should have been the lease liability, and then I will do the calculation. Whereas in case of modified retrospective approach, we will not go back to full, or we will not go back to fully restate the comparatives. So then how do we restate the comparatives? Here what we will do is, operating, if it was an operating lease under previous GAAP, if it was a operating lease under previous GAAP, please remember, operating lease, we did not recognize right of use asset in the previous GAAP. But in the current GAAP, that is Ind AS 116, we will recognize right of use asset. So if it was an operating lease under previous GAAP, lease liability will be equal to present value of remaining lease payment. So as on today, you will see how many lease payments I need to make. I need to make so many lease payments. What are the lease amount? This is the lease amount. What is the rate? This is the rate. So this becomes my lease liability. Okay. What should be the right of use asset? The right of use asset is option number 1. Either calculate the amount as per Ind AS 116. Option number 1, calculate amount as per Ind AS 116. That is one option. Second option is, whatever is the lease liability of calculated here, plus or minus any prepaid or accrued lease payment. Sir, what is this plus or minus prepaid or accrued lease payment? I have collected some advance money under an operating lease. That I will adjust to the lease liability and I will get the right of use asset. Okay, so for operating lease, lease liability is present value of lease payment. Right of use asset, I'll calculate as per Ind AS 116, or I will take the lease liability and adjust with the prepaid or accrued lease payment. Second, if it was a finance lease under previous GAAP, it was already a finance lease, then the standard says don't break your head. Continue the right of use asset and lease liability at the values at which you have calculated as per the previous GAAP. Okay, so let's have a look. Okay. So here, I will be doing more of a discussion only. And I'll see if I can pull this out question, the full solution, and give it off to you separately. So two things, sale and lease back, or not, sublease, and this one. A retailer entered into a 3-year lease of retail space beginning 1st of April of year 17 with 3 annual lease payment of 2 lakhs due on 31st March of 18, 19 and 20. The lease is classified as an operating lease under Ind AS 17, the previous lease accounting. The retailer initially applies Ind AS 116 for the first time for the period beginning 1st of April 19. The incremental borrowing rate at the date of initial application 1st of April of 19 is 10% and at the commencement of the lease is 12%. The ROU asset is subject to straight line depreciation over the lease term. Assume that no practical expedients are elected, the lessee did not incur initial direct costs and there were no lease incentives. There is no provision for dismantling and all of that. What would be the impact if it is a full retrospective approach and modified retrospective approach? Now first, let us see what happens in full retrospective approach. Full retrospective approach means I will go back right from the inception. I will calculate. So when will I go back? I will go back till 1st of April 17. And as on 1st of April 17, I will do the calculation that, okay, 2 lakhs is the lease payment. Present value factor 12%. Present value of lease liability 4 lakh 80. Then you will prepare the schedule, opening balance, interest expense, payment, closing balance. Please ensure you follow this format. There will be no confusion at all. Okay. So by doing that, 3,38,000 becomes the closing balance as on 31st of March of 18, and on 31st of March of 19, it becomes 1,78,589. Okay. This is the schedule. When are we transitioning? 1st of April of 19. Then ROU asset, you have 31st March 18, 31st March 19, 31st March 20. equally depreciated. So we have done that in earlier problem also. Now the lease is a 3-year lease in 17. So 18, 19, 20, right? 3 years what we need to look at. Now, how do we account for it under the full retrospective approach? So now, right of use asset 480, 480,000, 4,80,380, then 3,20,254, then 1,60,127. So as on 31st of March of 19, you have 1,60,127 as the right of use asset and 1,78,589 as your lease liability. Right now, when you first time account for it using the retrospective impact, what you need to understand is whenever we do a retrospective restatement, the 1st of April 18 balances also should be restated. Okay, because we'll understand this in Ind AS 8 subsequently, that though 1st of April is the effective date of transition, if I am applying something retrospectively, the comparatives should also be restated. So on 1st of April itself 18, you will say my right of use asset is 320,254 and my lease liability is 338,026. So on 1st of April 18, though we are transitioning on 1st of April 19, on 1st of April 18 you will say, sir, my right of use asset is 320,254 and my lease liability is 338,026. What about the difference? I am recognizing one asset, liability is higher, difference will be taken to retained earnings. That is the beginning part on 1st of April. So this is the entry you will pass. Then for 1819, what you will do is you will prepare or you will charge interest 40,563 and depreciation 160, 127. And then for 1920 also you will charge the depreciation expense and the interest expense. Okay, that is the approach where we do full retrospective. So things to keep in mind, whenever we are doing a full retrospective approach, calculate from beginning. Restatement will happen from the beginning of the previous comparative period presented. Right? If you have any questions, you can ask. I'll take up the question. Now, the second one is modified retrospective approach. Now, in case of modified retrospective approach, what did we learn? We learned that lease liability is equal to the present value of remaining lease payments if it's an operating lease, and if it's a finance lease, it would be ROU asset and lease liability as per the previous GAAP values. Now, here, what does the question say? The lease is classified as an operating lease. So now we are moving from operating to finance lease. We are moving from operating lease to finance lease. Now, under the modified retrospective approach, when we are moving from operating lease to finance lease, then what is the lease liability? Lease liability is present value of remaining lease payments. When is the transition happening? Transition is happening on 1st of April. Transition is happening on 1st of April. How many lease payments are left? One lease payment. Discounting factor will not be 12%, it will be 10%, which is the date of transition. Okay, so by applying the right of use asset, by applying the 10% discount factor on lease liability, we get the present value to be 181,820. This is the lease liability. Then the lease liability, simple, opening balance, interest, payments, closing balance will be 0. And right of use asset, how do we calculate the right of use asset? The right of use asset, if you see, is what? Right of use asset is either amount as per Ind AS 116 or lease liability plus or minus prepaid, accrued or lease payment. So here, first one, just a second please. So now ROU asset calculated as per your again Ind AS 116. So you will apply ROU asset calculation from Ind AS 116, and then how much will be the closing balance of that particular right of use asset as per Ind AS 116. That is what will be what will be considered to be the opening balance of right of use asset. Just take it the calculation. Here, okay. That's why I always prefer. I didn't, share my own Excel. In my own Excel, I have a flow in which the working are done. Sometimes it is difficult to track in the study material where they have taken. Anyways, so present value of lease payment is 497,360. Right? Present value of lease payment is 497,360, and that if you depreciate over a 3-year period, the opening balance is 165,787, and that is what is being considered as the opening balance of the right of use asset. So under the modified retrospective approach, in the first category, lease liability is present value of remaining lease payment, and right of use asset is the carrying amount as per Ind AS 116. So if you have taken carrying amount as per Ind AS 116, it is 165,787. Right now, that is how what will be incorporated. And where will we take the difference? The difference will be taken to the retained earnings. So as on 1st of April, you will take the difference to retained earnings. Difference between the lease liability and the ROU asset will be taken to retained earnings, and subsequently you will account for it using the effective interest method, that is 10% of interest expense, and you will also, so 10% of interest expense is 18194, so slight rounding of difference, and 165,787 will be your depreciation expense. That is using the modified retrospective approach, option 1. Then when we are using modified retrospective approach under option 2, the lease liability is based on remaining lease payment, which is 181,120, and the ROU asset also is, see this, ROU asset also is lease liability plus or minus any prepaid or accrued lease payment. Now here we do not have any prepaid or accrued lease payment, so the lease liability will be equal to right of use asset, and there will be no need to adjust any retained earnings. So just to summarize, full retrospective approach, restate comparative as if Ind AS 116 was always applied. Modified retrospective approach, no need to restate the comparative. As on the date of transition, if it was operating under the previous gap, operating lease under the previous gap, take lease liability, which is present value of remaining payment. Right of use asset, option number 1, carrying amount as per Ind AS 116, whatever you have calculated. Option number 2, the lease liability plus or minus accrued payment. Then if it is a finance lease, carry the amounts as per the finance lease, whatever is the asset and the liability, same thing can be carried forward as whatever was there in the previous gap. Okay, so this is again a very important topic when it comes to modification of a transition thing. That for lessor, there is no adjustment required, only other than in case of if he is an intermediate lessor. So why intermediate lessor? Because for an intermediate lessor, he also is a lessee. So because he is a lessee, for that transition you will be accounted as per the transition approach. Okay, now if there is a sublease which was accounted for as an operating lease earlier, but now finance lease currently, then in that case you will account for it as a finance lease as on the date of application. The difference between the right of use asset and the lease liability, Vishnu, will go to the retained earnings. It will not go to the, because we are doing a restatement, right? It will be taken to retained earnings. We'll understand more of it in Ind AS 8. Okay. Now, quick things on scope and exclusions. Ind AS 116 applies to all leases, including RA assets in a sublease, except for leases to explore or use mineral oil, etc., which is covered by Ind AS 106. Leases of biological assets are covered under Ind AS 41. Service concession arrangement, which is covered under Appendix D to Ind AS 115. Licenses of intellectual property covered under Ind AS 115. Then license agreement for items like motion picture films, etc., which are covered under Ind AS 38. Then one very small and important part, which is recognition exemption. Now see, this standard is a very complex standard. Even in a fast track mode, we have taken 5 days, 7 hours of class to understand this standard, right? A regular class, as I told you, is about 20 hours, and there have been 1000 pages of books for this single standard. That is the complexity in this standard. So what the standard has done is there are some recognition exemptions which have been given. So what is the recognition exemption? First one, short-term leases. So if a lease has a term of 12 months or less and there is no option to purchase, then you can exempt that lease from accounting from applying the principles of Ind AS 116. Then in that case, you will take it as a normal rent expense and charge it off. But if there is a purchase option or if there is a transfer of asset, then you cannot apply this exemption. Then if leases are for underlying asset which is of low value to an entity, for example, Reliance gives mobile phone, just for argument's sake, takes it on lease and gives it to all the employees. So in that case, because the underlying asset is of low value, the entity can decide that yes, we will exempt it from this particular requirement. Okay. Now, if you are taking the low value exemption, lessee must benefit from the use of underlying asset on its own or together with resources that are already available and they are not highly dependent or highly interrelated with other assets. So low value exemption will be based on these two criteria. I can take the benefit on its own and it is not highly dependent. Head leases do not qualify as low value assets. So head lease means if there is a lessor, intermediate lessor who is a lessee, he cannot say, and he is doing a subleasing, he cannot say the head lease is a low value asset. And this is only for lessee, okay? The lessee can do this exemption. Then if you are taking this exemption, you will account for it as an expense over SLM basis or any other systematic basis. Then if there is a lease modification or change in lease term, you will see whether it is a new lease or not. Okay. So broadly, this is what is covered. I've tried to cover as much as possible in the limited time with what we have. Right. A regular class, as I told you, would go on a lot. Now, my ask from your side is please practice the questions in the material and also from the back practice questions and also from the past exam questions. Practice is important to the standard. Don't keep it, sir, now I've understood the concept, I will practice near the exam. Again, you will miss the concepts. Okay. So one thing, practice as many questions as possible. And then another important thing is very important standard. Almost every attempt we get a question. Maybe some attempt we may not get a question, but still very important. And from a real life perspective, in interviews and all, this is one standard which is definitely going to be tested for a lot of you. Okay, so that is one aspect which I wanted to highlight. Any other questions you have, any other feedback, any other asks you have, please feel free to put out in the comment section and I'll be happy to address you. We will not have class on Saturday and Sunday. We'll next resume our classes on Monday with a new standard Ind AS 115. Now in these 2 days, it is your responsibility to finish up. If you have missed videos, if you are attending today for the first time, go back, complete the standard, and then we'll start with Ind AS 115. Objective is to cover as much as possible in the limited time that we have allocated and to make you exam ready. Okay. If you have any more inputs to be given, on the speed, on the coverage, and all of that, please feel free to put it up. And yes, there was some ask from some students that can we solve more problems. It will be very difficult. See, if I start solving problems, it will be very difficult to do justice to the objective, right? So my idea is, the major concepts are clear to you. Then second objective is you are revising for the examination. An important question whenever I feel there is a tricky thing involved, like today, I did one calculation for sale and lease back. So to that extent, I'll try to put down the workings. The follow-up work that you need to do to take the best, to make the best of these sessions is to go back and revise and practice in whatever time limit you have. And if you have been getting benefited by this session, do subscribe to the channel. Of course, you would have already subscribed, and also share it with your friends so that we can reach more and more students, right? So thanks a lot for showing up again and again for continuous 5 days. And that is I'm grateful for that, and as I told you in the beginning, that keeps me motivated. Okay, so the link to WhatsApp group is there. You can join the WhatsApp group, you can download the notes from the app, and then we'll continue again on Monday. So have a nice weekend, and take care of your health. Bye bye.